Are live without a net today. The grown-ups have all gone home for the week. It's just me, Jack Farley, and Max Wiethe. Welcome, guys.
Great to be here, Ash.
Yep.
So, guys, obviously today's Jobs Day. NFT number out. Jack, what are your thoughts?
Did you just say NFT number?
Yes, I did, Jack.
Okay, so just to explain, NFP is non-farm payrolls. That's a jobs report. Ash is so in the crypto world, he's so focused on NFT, non-fungible token. He said NFT.
Yeah. And by the way, I've spent years of my life working at a macro consultancy. It is like the emotional connection I feel to NFTs is overwhelming. But Jack, go ahead. Non-farm payrolls number, Jobs Day today on Friday. Let's take a look at those numbers. What are your thoughts?
Sure, Ash. Well, the non-farm payrolls number was 916,000. That's the number of jobs that was added in the month of March. That was well above expectations, Ash. The median expectation from Bloomberg was 660,000. The whisper number just shy of 800,000. So it was a big surprise and a big beat that, yeah, it indicates strength of the U.S. economy, no doubt.
Yeah. Job growth continuing to grow here in the United States, obviously off those terrible numbers that we saw at the height of the pandemic, going back some 10 to 12 months ago at trough. And now we've seen this continual recovery. Obviously, good news. We should say, obviously, right now, for those watching, there is an attack that just happened, a small attack that has happened at the U.S. Capitol. Apparently, an individual rammed a police checkpoint at the U.S. Capitol right now at this hour. NBC News is reporting that the suspect has been killed, and there may be additional injuries at the site. So with that said, and that rather grim opening, to shift gears here to talk about things that are happening in the economy, which is what we're here to discuss. Max Wiethe, by the way, it's a pleasure to have you on this show. We don't usually get you out on these live streams for a Real Vision Daily Briefing. It's a pleasure to have you here. You work predominantly on the plus tier at Real Vision, thinking about some of the things, the content that is a little bit more institutional in nature. I know you've been working on some interesting pieces these days. What's on your mind?
Well, it's a good mix. Like, we do have some institutional content, and some of the stuff that I'm working on that's more institutional is actually going to be on the essential tier. So it's a mixed bag for me. But there's a piece coming out on Monday that I think is really interesting with a guy, Marcus Frampton, who runs the Alaska Permanent Fund. So for those of you who don't know, Alaska, when they struck oil back in the 70s, they set up a sovereign wealth fund for the state, which, considering we don't have one at the national level here in the U.S., seems a little foreign to people. And he says in it, like, their structure is actually very similar to a state pension fund, but imagine that every single resident in the state gets a pension. So they pay out a dividend from that to the citizen, so every citizen of Alaska gets that. It's a really unique fund, but more unique than the structure of the Alaska Permanent Fund is the man running it. And Marcus, their CIO, he had a long career in private equity, but he's one of the few CIOs who's really not buying into the massive private equity trend. He's bullish on gold. He's bullish on active management, bullish on macro hedge funds. I mean, he's really just like the opposite of what the institutional world is heading towards right now. And their returns have been pretty good, and they've been able to pay out that dividend pretty consistently over his tenure. So it seems to be working, at least for now. So I think it's a really interesting interview from a guy who also, in his free time, invests in microcaps. So like obviously the institutional world, they're not getting into that. So there's a section in it where he talks about like why he loves trading over the counter stocks. So he really is a man of many talents, and that one's just a lot of fun. But more than anything, going back to not what's happening on Real Vision, but the economy.
But by the way, I want to jump in because I wanted to ask you some questions about it, because I'm fascinated by the Alaska Permanent Fund. It's a very large fund. It's like $70 billion, pretty significant amount of money. What is the fund? What are the constituents of the fund? What's their investment philosophy? What do they invest in up there?
So they have it's an institutional portfolio, so they have certain things. Like there's a part in the interview where he's like, we're invested in gold miners, and probably a hedge fund that is actively picking the best miners would be better. But to get that through the pipeline would be too difficult for us, so we just bought the ETF. So you get to get a picture into like maybe how decisions are made in an institutional portfolio and why certain things happen. Like he believes that this is the best investment decision for the state of Alaska, but he just, in the time that it takes, when he's like, gold miners, I want to invest in them now, he probably couldn't get a hedge fund through the pipeline fast enough to catch that run up. So he's just buying an ETF. I mean, they have equity exposure, they have bond exposure. He talks about how, a lot of people are saying like bonds are dead, bonds are just a drag, and so equity exposure is going up. But he's not cutting his bonds, so he's at about like 25% bond or fixed income, like carrying that pretty heavily. And then also active management. That's like another one of the things that stands out for them. So of their equity exposure, about 70% is active. But he's a guy who likes microcap investing and doing individual name research. So you can tell where some of the stuff he does in his free time kind of comes into it, and where a lot of allocators like him maybe don't have that experience. It's not the world they live in. Like the interviewer, Sean Feeler, who is he actually runs a fund that's focused on gold miners. Ironically, the thing that that Marcus couldn't get them into. But he says like that's got to help you interviewing managers that you're allocating to. He's like, yeah, it definitely helps to be able to tell like who can really hack it as a stock picker and stuff like that. So he's just a fascinating guy, and it's an amazing fun. I mean, maybe if you're watching this from Norway, you're like boring. Like we've got sovereign wealth. Like don't talk to me about your Alaska fund. But here in the U.S., it's a really unique structure and a really unique guy running it.
Yeah. And I'm sorry, I interrupted you. You were going to say you were shifting gears to talk a little bit more broadly.
Well, the economy, I mean, I love what I do here at Real Vision, and it's fun to get into that, but I'm sure some people want to hear about like what we're watching, what we think is moving markets. And I'm here in New York. It's Friday. I think next week people in my age group are eligible for the vaccine. They just opened up to anybody over 30. You no longer have to be part of these special groups. I'm sure, Ash, I don't know, maybe you were already there. I don't want to ask you about your private medical conditions, but anybody.
Max, Ash is under 30. He's like us. Ash is under.
Yeah, 30. Ash is under. This is the under 30. So Ash, you're eligible next week to get the vaccine. But we had a record number of vaccinations yesterday here in the U.S. at over 4 million people getting a dose of the vaccine. We're up over 25% of the people have gotten at least one dose. I mean, it's really accelerating. We are seeing more people opening up, which just means the spots are going to be more filled. You've probably all heard stories about vaccines going bad or people not showing up to their appointments, and people who maybe aren't part of these special groups are like, hey, I really want to get vaccinated, like open it up to me. So I think that that's a trend to be watched as summer comes around, and we will see whether that really leads to the sort of summer explosion that a lot of people have been saying is going to happen here in 2021, in combination with good jobs reports, in combination with good vaccine reports. I'm pretty interested to see how the market reacts to some of this bullish news.
In combination with cannabis being legalized here in the financial hub of the United States?
Not just legalized, you can, like, if you go to certain, like in California, not that they enforce this or anything like that, but you can't smoke on the street, you can't smoke outside. Well, here in New York, nobody has a yard. And so they have legalized it anywhere where tobacco can be smoked. You can smoke cannabis. Yeah, so it will be, it won't change anything because it's basically already been like that here in New York. Anybody who's been here in the last few years probably recognizes that. But Jack, you grew up here. So, how has the change been for you, seeing all this stuff happening here in New York?
Are you talking about marijuana legalization?
Yeah. Like, what was it like?
I mean, sorry, Max, I've got my eye on the bond market. I don't really.
All right, we'll get back to this in a moment, but let's talk a little bit more about some of the big macro issues that we've got coming. By the way, to your point, Max, about the vaccine, I had got my shot. My first shot about a week ago on Monday down at the Jacob Javits Center. This is a huge convention center here. And it was a pretty impressive feat of logistics. And it made me feel pretty good about being an American, actually, to see that we were able to pull something off on this scale. You have these terrific young people, young men and women in uniform who were directing traffic and kind of steering people around and checking papers and doing that kind of thing. And it just worked extraordinarily well. Logistically, this is not a simple thing to do. It's something that's very challenging to do at scale. And it's something that it really is an impressive feat that we've been able to not just develop the vaccine, this extraordinary effort in 12 or 14 months. For some people, a year after they had first heard about coronavirus, and they got their first vaccine. That's extraordinary that we were able to not just create it, test it, but also get it out to people logistically. An extraordinary feat, and one that continues to go on. And obviously, there's this narrative that we were just touching on in some ways about the potential for the growth to continue to explode, the rebound effect. You see all of those NFP numbers. Again, all the non-farm payrolls growing pretty dramatically, and this is look, this is quite a rebound. And we've been talking about this reverse radical effect. The question is, remember, if you think about economic growth as trend, we've come down, we've done this reverse radical, we've come back, but we're still not where we were, and more important, we're not where we would have been if we continued on trend. And that's one of the important things to think about, I think, as we take the non-farm payroll number into context. This is still an economy that has been significantly impaired by the shutdown and by the self-shutdown, people not going out and not doing things at the level that they would have otherwise. But to get back to Jack's point, part and parcel of all of this from a macro framework perspective is what's happening in the bond market. What was the response in the bond market from today's jobs report?
Yields rose, Ash. Yesterday they bonds sold off, but bonds rallied and yields declined. But today bonds sold off because investors were saying, if the economy is running so hot, why do I need a safe haven asset like a bond if I can go into equities? Now, the equity market was closed today, so there was no trading. However, the futures market was open, and the S&P 500 futures, as you can expect it, I believe it was the June contract, surged on the news. So stocks liked the news because stocks are a risk asset. They do well when the economy is doing well. Bonds, which are sort of a rainy day fund, if you will, you want to hold them when maybe the economy is not doing so well. They're negatively correlated to equities historically. They sold off. So this good economic news was good for the stock market, which again wasn't open, and bonds sold off. Interestingly, I saw that Eurodollars, which is basically what the market is pricing in for the future of interest rates. I think in December 2023, that the 3-month bond, it actually plummeted. So people are actually expecting that the Federal Reserve will have to increase rates because of this inflation. But then inflation goes back to the labor market. Unemployment, as you said, Ash, is now at 6%, a drastic decline from where it was. But it's still somewhat high, and it's really hard, no matter how much money is printed, to have inflation if unemployment is at 6%.
Right. So just to summarize, job numbers comes back strong, bonds sell off, rates rise on inflation fears. Now you're saying this is what we're seeing also in the Eurodollars market, which is effectively looking ahead to what's going to happen in fixed income. And the question now on the table, Jack, is what does the central bank do? It seems that Jay Powell's remarks have been dovish, the implication being that they're talking about things like symmetric targeting of the rate, meaning that they're going to let the economy run hot for a while. Anyone who's been betting on rates rising has not done so well. What are your thoughts on that?
Well, I think months ago, Jay Powell said that he's not thinking about raising interest rates. He's not even thinking about raising interest rates. I take him at his word. I think short-term rates, the federal funds rate, is pretty much pinned at the extremely low level it is today. However, what he says about the long end of the curve, which has been selling off, we had some bear steepening because people are saying, why do I want to own 30-year bonds if the economy is on fire? There, he really has totally dodged the question of if he is going to enact yield curve control. He says, we're really not thinking about it. We're really focusing on structural unemployment. He basically dodged the question. So I think that is the most important thing. But just go back to something.
Let me just add a little bit of context there for a second. So effective federal funds rate, this is the rate that the Fed controls directly. It has been effectively at the zero bound now for some time. EFFR right now looks like spot 0.07. 0.07, so effectively at the zero bound. What you're talking about is the rise in rates at the longer end of the curve, beyond 10 years, 10 to 30 segment of the curve. This is something that is not in the direct control of the Federal Reserve to date in terms of the current policy tools. When you hear the acronym YCC get thrown around, those are yield curve controls. This is the potential for the central bank, for the Fed, to step into the market and start buying at the longer end of the curve to push rates down. This is obviously something that we've never tried before here in the United States. We've done something called Operation Twist, which was a balance sheet neutral version of this, where you would buy at the longer end of the curve but sell on the short end of the curve to offset it. Just to be clear, yield curve control, something that's very controversial, not yet been implemented in the United States. Impact potentially unknown.
Yeah, well, it was implemented in World War II. Just historical caveat for you there, Ash. But I would like to talk about it in relation to a narrative from earlier in 2021, which was about the reason why yield curve control would have to be implemented was because rising yields were going to crash the stock market. Well, here we are, yields are rising, economy is running hot, and equities are at all-time highs. I mean, we're closed today, but futures went up. You could argue maybe people were hedging potentially Monday's open, but all that being said, it's very clear that at this point, rising yields have not crashed the stock market to date. And I want to bring it back to Real Vision Content, which was the interview that aired today with Chris Cole and Mike Green, and they were talking about credit markets and how that is really the big thing, is the refinancing of debt, and that, well, which when insolvency risk rises, that also affects equities, because equities are like an option on a call on the free cash flow above debt service. And so the idea is that as rates rise, it affects the ability of corporates to refinance their debt, whether they are the zombie companies that many people have been bemoaning or just other companies that have been levered up, whether because of coronavirus or the leverage that was running rampant before coronavirus. So really, yield curve control, until it affects people's ability to refinance, which affects the equity market, like, why would they implement yield curve control? Is the Fed put really at 4,000? You know, like, is that where the Fed put is struck these days? So all this talk about yield curve control, I think, was a little bit fast.
Yeah, I think it was premature. By the way, what Max is alluding to here is this idea that the Fed is effectively targeting a level on the S&P 500, 4,000 obviously being one that we just crossed fairly recently. I was actually just reading on the Liberty Street blog at the New York Fed about the alleged yield curve control during the 1940s. It seems a little bit ambiguous to me, but we'll take a look into that. We'll continue that debate on platform.
Plenty of people smarter than myself have said it happened, and I'm willing to trust them. I wasn't alive. There's no way for me to know. I don't think anybody who was working at the Fed in World War II is alive, so we have to trust the history books.
And by the way, for people at home, I want to say it's not that the Federal Reserve has never bought bonds on the long end of the curve. Yield curve control is specifically targeting a rate and saying, right, if the rate goes above that, it's Armageddon. I'm going to just buy as many bonds as we need to in order to keep it at that rate. Like under quantitative easing or QE, and what the Fed is doing now, which is minimum $80 billion of Treasury per month. Often it's much more. They buy treasuries on the long end. They're just really focused on that belly of the curve where, you know, a lot of corporate bonds and high yield bonds are in that duration. And the 30-year bond is something of an afterthought, you know, that there's the 30-year mortgage, which is dependent on that, but they're really focused on the belly of the curve. Whereas with yield curve control, they really would target to prevent a further bear steepening. That, as you say, Max, some people said, oh, it's going to get out of control. The stock market, S&P 500, yesterday, it's at 4,000. What are you going to do? As yields have risen, we haven't seen that weakness in the equity market. You've seen it in patches. FANG has, been weakening since then. High growth stocks like Tesla, DocuSign, Zoom, Peloton, they've been taking on the chin. And I think that the people who said the stock market is going to do poorly, they were right about those stocks. What they didn't anticipate, Max Ash, I think, is just how well the reflationary names would do. Your airlines, your energies, your reopening stocks, the Roaring 20s stocks, which Max, you were talking about earlier.
Can you guys both talk a little bit about the this rotation trade that we've been talking about, away from growth toward value? Whenever that the data appears to turn, it can reverse. Give us a little bit of a context for people who aren't familiar with the reflation trade, as we've been discussing it, what that means and why it's significant, particularly for U.S. equity investors.
Sure. Well, growth stocks, like let's take your FANG stocks, Facebook, Alphabet, Netflix, Google, they grow really quickly. And they are called secular growers. They can grow when the economy is not growing. In other words, there's a spread, but they can grow when the economy is not growing. Whereas a company like Exxon or a company like, let's say, American Airlines, they really are dependent upon the economy. So when the economy grows, they are lifted. But if the economy does really poorly, then they don't do poorly well. So otherwise, there are tech stocks, which are growth stocks, which are independent really of the growth cycle, and then there's cyclical stocks, which are dependent on the economic regime. So when things, when shit hits the fan, pretty much, your growth stocks actually do better because they can grow despite a strong economy. However, the strong economy that we're witnessing, Ash, before our eyes over the past 3 months, this great economic data after great economic data, that actually is bad for the growth stocks, like the FANGs, as well as your tech stocks.
Yeah,
but that begs the question: is it the yields, or is it the relative attractiveness of the other options that are out there as growth comes? Like, is it really, the narrative was that yields are affecting the discounted cash flow model, like as rates rise, these earnings out in the future are less attractive, or is it just that we're getting bullish economic data, and thus these stocks, which are much more dependent on the health of the economy for them to see earnings growth, are more attractive? It's the opportunity cost of owning one versus the other, not that one is being crushed by a 1.71% 10-year yield.
Sure, but Ash, the reason that the 1.7 10-year yield has risen is because people are bullish on the economy. So they are very related.
Yeah. By the way, Max, you are correct. Apparently, in April of 1942, the rate had a hard cap. The Fed capped at 2.5% at the 25-year duration, which I think was the longest end of the curve in the 1940s. And that existed until inflation started to rise in 1947. So it appears it is within the technical definition of YCC.
Yeah, it was to fund the war, and then we had like one of the greatest economic expansions of all time.
Hey,
something
guys,
like that.
We got a question. We got a question from Bob. Bob, very relevant question. Says, how high do you think 10-year treasuries have to rise until the market pukes?
So if you watch the video with Chris Cole and Mike Green on Real Vision today, they talk about that if we get to the rates that we had in the mid-2000s, that cuts corporate earnings by 1/3. And there's some and that's like a best case scenario. It doesn't get into the zombie companies that can't even afford to, can barely afford to service their debt now. It doesn't get into the companies that rely on refinancing to keep this debt going. So that's just kind of like the number. So go back and look at that number back into, I don't have an idea of where, sorry, I was 8. I don't know where, maybe Ash can help us. What were interest rates in 2004, 2005?
At which duration?
Let's just go with this 10-year yield.
So let's take a look. I avoid eyeballing things when I don't have to. So in the year 2000, rates on the 10-year were at approximately 6%. 6%. Right. Okay. It's an important benchmark for us to think about as we think about just the, as we discuss these, these rises and that are relatively significant on a short term. The bottom line is these are massive, massive spreads away from where we were just 20 years ago. And the long-term average, I mean, one of the most stable charts in all of macroeconomics is just look at a 40-year chart of the U.S. 10-year Treasury yield, and it just continues. It's a ski slope from the top to the bottom. You think about this, the peak of interest rates in the United States around 1980, 1981, around 11%. And coming down, close to zero. This is an extraordinary, extraordinary decline. And if you're trying to calculate something like a long-term average, there's the weird sort of mathematical basis for this. As you continue to expand the window, it just keeps getting higher and higher because you're pulling in older data that was from the higher base effect. So, the most durable thing that you can say about this curve is that there's just been a significant continual roll down in rates in the United States dating back some 40 years.
Yeah, it's a pretty clear trend, and that's why Rao calls it the chart of truth. And there are guys in the whole saying about the bond guys are the smartest guys in the room. I mean, they did just have the greatest trade of all time that they could just ride for a 40-year career. If you started in finance in the 80s in the bond department, it's a pretty good deal there.
Yeah, last print I just saw on UST 10 is 1.7%.
Yep. So we still have a ways to go before we even get close to that number. And I think they said the average in this Mike Green, Chris Cole interview. And I mean, I pulled it up here. Like that 6 number was relatively high. If you basically take 2000 until the financial crisis, I think we were maybe around like 4% most of the time. But that's still a ways to go. 4.5.
Yeah,
but I'm suggesting that how can you really say what the long-term average is when the trend just looks like this? You go from up here to down here. So the long-term average, it just depends where you place that window, right? Like you pick your time horizon and you can pick your rate, because this isn't something that had a stable kind of horizontal line. It's just been sloping down for that entire 40-year period.
So I just want to connect all these conversations. I feel there's interest rates, which is what you're talking about. Interest rates have secularly declined, and then there are credit spreads. So when you buy an investment grade bond, a high yield bond, you're buying the interest rate, and then you're buying the credit spread on top of that, with high yield obviously having a higher credit spread. And Max, what I watched your interview, or the interview that Chris Cole had with Mike Green, one thing that struck out to me is how when credit spreads blow out, that is a precursor of equity markets blowing out. And I was just doing a little bit of research on this data platform that I have gotten before, and it turns out that the S&P 500 is extremely sensitive to credit spreads. The NASDAQ is less sensitive to credit spreads. Why is that the case? Right. Well, because the NASDAQ is chock full of growth companies that aren't dependent on bank financing. They don't really need a loan. Apple is saying, hey, our problem is we have too much cash, not too little. That's not a problem. But if you're an energy company, I mean, that really is a sector that is driven by debt and cheap financing. So I think credit spreads have been extremely low. They're very close to their pre-pandemic levels, and that's largely because of the Fed. So even though, and I found this interesting, I know I've talked about this before, since August of last summer, if you had owned long duration treasuries, you would be down about 18 to 20% because yields have spiked, and those long duration bonds are very sensitive to interest rate spiking. If you
Jack, do you personally know that 18 to 20% number for some reason?
I know it from a chart, but I have tried my hand at TLT, and it has not been a good trade. I admit it. But LQD, which has about a 7-year duration, that is down about 7%. And HYG, high yield bonds, have actually done the best because credit risk has not been a problem at all.
Yeah.
Yields have risen, so they have the least exposure. So I just found that interesting.
Yeah, this is a fascinating point, Jack, and really a spot on one. So LQD, of course, is the investment grade ETF, ETP, I guess I should say, exchange traded product. It's a note. But what's interesting about this is the point that you make about credit spreads. So although yields have marched down very steadily for over a 40-year time horizon, there's been tremendous variability in the spreads between investment grade and high yield, and also between the benchmark rates on the 10-year Treasury and high yield. This is the fluctuation of perception in the creditworthiness of the U.S. corporate sector. And when you say that there's been no challenge with those yield spreads, I mean, effectively what that means right now here in 2021 is that it's been Fed intervention injecting not just liquidity via the traditional monetary transmission channel of lowering rates and expanding the balance sheet, but also the so-called 13-3 programs of the Fed, directly injecting liquidity into the markets by buying corporate treasuries. And that's compressed the spreads rather dramatically, but that's not a function of market perception of credit risk. That's a function of central bank intervention, and it's an important point for people to understand who are thinking about this, because ultimately that policy action needs to be unwound as the economy begins to ramp up. So you have different factors moving in different directions as this reopening trade takes place, as you see sectoral rotation, and as you see the continued job growth, the reversal of the job loss might be a better way of saying it. Sounds a little bit more negative that way, but that's more certainly closer to the reality that we've seen from this devastating event.
Well, and Ash, there's another factor in there, which is with treasuries giving you almost nothing. I mean, we're up to 1.7%. I don't know what the real yield is. I think it's still negative at this point. It's also the market's supply and demand dynamics for yield. And so as much as credit spreads are always touted as like the credit worthiness, there's the Fed intervention aspect of it. And there's the actuarial, institutions, pensions, they need to hit their targets. And if they can't get it from a treasury, they're going to have to go up. And even though investment grade is supposed to be relatively safe, that's where they're going to go. They're going to go where they can get a little bit more yield. And so there's other dynamics beyond just the credit worthiness, which are driving spreads lower.
That's important. And guys, I actually encountered something today which blew my mind. I was looking at the 1 month implied volatility of HYG, or the high yield ETF. Implied volatility is basically saying how much does the market think this is going to move to the upside or to the downside. And I encountered the chart I put it over the past 1 year, and then I said, hey, that shape looks familiar. And it's an exact match with the actual high yield credit spreads. So in other words, as credit spreads have been going down and people have been saying, oh, hey, high yield is a good place to go, the market, in terms of pricing where it's going to go, in terms of downside risk, really, is not at all worried. So you have this reflexive thing where the lower spreads go, the less worried people are.
Yeah. Here's a question that comes to us from our audience, from M. Cook. How did the Fed determine the 2% rate number? What's behind the math? Hypothetically, if the Fed was to pick the 10-year for YCC, what would happen if the 5-year or 30-year were to rise? Obviously, those are two different questions.
Yeah.
But who wants to jump in and talk about?
The first one's easy. It's the 2%. It's not a target of rates. It's a target of inflation. And to be honest, I don't know. I think it is probably based on something related to the Phillips curve, which is the relationship between inflation and employment. People saying, oh, when unemployment is extremely low and there's so much employment, inflation happens. So there typically was thought to be that relation. So 2% was sort of chosen as that happy medium, I think.
Well, 2% is also the new 3%. So for a while, 3% was the number, but then they couldn't hit that. And so it's also a credibility number. Like if you can't generate any inflation and you're supposed to be targeting 3%, you look like you have no control. But 2% and you're like, oh, we're just a little bit short, it makes you look a little bit more omnipotent. So I would...
I love Max's cynical game theory interpretation of the 2% target. I think, for inflation targeting, I'll give you a little bit of a general framework that may not be, it's just a little bit more broad. So obviously, it's well known what the risk of inflation is in an economy when prices begin to rise very quickly. Obviously, it's a massive tax on everyone in the economy. It's a tax on wage earners, and it's especially a tax on debtors. So the thinking in how you determine that, and I'll talk a little bit more technically in a second, but that's the big picture. Obviously, we all know why inflation is a bad thing. The flip side is why prices, when they fall too low or continue to trajectory downward, becomes problematic. And that is about the risk of the paradox of thrift. The paradox of thrift is the idea that when economic impairment is coming, that people begin to hoard their cash. And the challenge with this, of course, is that your revenue is my payroll. So if people stop spending money, you see this processional effect that can happen throughout the entire economy. One of the reasons why some economists, in a very non-technical way, talk about that 2% inflation target is because the fear of deflation is such a risk in the post-World War II economy that the Fed has targeted this rate. This is just the argument. I'm not saying that I agree with it. That the Fed has targeted a rate to ensure that the economy does not slip into deflation, because the effects of it can be so potentially catastrophic. The point that Jack was talking to, which is spot on about the Phillips curve, there's something called NAIRU, the non-accelerating inflation rate of unemployment. And the Fed historically obviously has a dual mandate to target, on the one hand, stable prices and maximum employment. Maximum employment is generally viewed through the context or through the lens of NAIRU, the non-inflation accelerating rate of unemployment. That's effectively where the balance comes from. It is a Phillips curve related thing. You can debate how precise that math is. I guess a cynical way of saying it was like, yeah, 2%, it's just a little bit, just make sure we don't fall into deflation. But that's a bit of the thinking. And if you'd like more information, the Phillips curve and the NAIRU articles that are up on St. Louis Fed are very good places to start.
Yeah, and Ash, you'd think that the maximum rate of employment would be 100%, but actually it's not.
It's not.
Well, and that's another thing about when people say, the Fed's going to have to raise rates. They've been pretty clear. They have a dual mandate. One is to price stability, is what they call it, which is the 2%. Think of it, the 2% inflation, as price stability. That's not prices going nowhere. That's not prices going crazy. That's stable enough for them to avoid deflation, to inflate away some of the debts that everybody has, and to generate growth. But then the other side of that is this maximum employment, which is not 100%. But 6%, like, it's better than where we were in the depths of COVID, but it's still,
right.
I mean, compared to where we were, it's very far away from maximum employment. And although things are looking good, we're not seeing the rapid acceleration that we were, when we were coming out of the depths of hell. And so that is the main thing that people who say the market is getting ahead of itself on these rate hikes would probably cite, is how far we are away from maximum employment and the rocky road that we have to get there.
Yeah, spot on. Important points from both of you, and definitely on not 100%. And to Max's point, stable prices are not prices that are not rising. It is just not rising at a rate that is problematic in the view of the central bank. So obviously, those are very controversial topics. There are people who would love to argue the other side of the issue, especially on the Austrian side, which perhaps, Max, is the segue that we were looking for to talk about what is happening in the digital asset space right now.
Well, before we get into digital assets, I just want to get to the second part of M. Cook's question, which is about if the Fed was to pick the 10-year for YCC. Well, it's the yield curve. It's not 10-year yield control. It's yield curve control. So the question about, like, what happens if they're targeting them all. They're targeting every spot on the curve. And so they're supposedly all not rising. And then if you look at Japan, who has implemented yield curve control, it's that if the market buys that yield curve control is happening, you actually have to do less because there's less action in the bond market because there's no money to be made on fluctuating prices. Like, money is made in volatility. If there's no volatility, there's no money to be made. There's not as much people trading that, and thus Japan actually has to do less yield curve control because, and they've made some changes. I don't want to go down into the Japanese banking policy changes that have come out recently this month, but that's to finish M. Cook's question. But Ash, what was your question?
No, I was just going to say, long-term, big picture, the last 20 years in Japan have not been anything that the United States wishes to emulate. And, what yield curve control means effectively, at least in its strongest form implementation, that market forces no longer control interest rates at any point in the curve.
Yep. But Ash, what was your question about digital assets?
Yeah, let's go to digital assets. Volatility.
Yeah, I mean, based on my Freudian slip at the beginning of this show, what I've been thinking about for the last 2 weeks, pretty much nonstop.
So what was the closing price?
Is that the Ash Bennington NFT?
On the Ash. I thought you were punning on the fact that crypto markets trade 24/7. It appears that the red mic #1. My name is not in the title, by the way. The closing price on the meme that someone, John Amatuli, actually one of our subscribers, put together a meme that he turned into an NFT. It's a picture of me wearing a T-shirt that says aggressively neutral, and it appears that the closing price on that was $390, or, Max, for you, 0.19 ETH.
Okay. All right. Well, Ash, I guess what I want you to do right now is convince me that NFTs are not hot garbage. Please, please. For me, I'm going to try and be open-minded, but I'm of the mind that NFTs are. This is so early. I get it, the whole idea that we will live in a digital world and that people will interact, but I think the chips in the brain first. Then NFTs, that's more.
Chips in the brain. Chips in the brain. There's no secondary market for that, Jack. I
know there's no I'm saying that until we live in a world where you actually want everybody it's better to be in the digital world and we all go home after work and plug in, or we even go to work plugged in. Then I see it, but I don't see it when going to a great restaurant in Manhattan and a club is still better than anything you can do in the digital world. Until that experience has been surpassed by the digital world and the things that the richest people in the world want to do are in the digital world, I don't see the NFT thing. People still, until digital skiing is better than going to real Stad, then I don't see it that. I think that bridge needs to be crossed first. That's my take. Convince me why I'm wrong.
Listen, that's a fair take. I think a lot of people saw, for example, the Beeple NFT at $69 million, and there were a lot of people scratching their heads about precisely that number, right? I think it was a pretty extraordinary number, and I'll get back to that in a second. But the first thing I would probably say, Max, is what are NFTs, right? What are NFTs and why do they matter? Why are they significant? So an NFT, big picture, Bitcoin, Ethereum, most of the coins that we think about when we think about cryptocurrency are fungible. What fungible means is that any two units are equal. This is a very simple concept to understand. The language is a little fancy, but the concept is really simple. Max, if you have a $100 bill in your pocket and I have a $100 bill in my pocket and we switch them, there's no economic difference between it. You're happy to take my $100 bill. I'm happy to take yours. There's no distinction. So Bitcoin and Ethereum are fungible in that sense. All of the tokens, all of the coins are absolutely equal in every way. What makes an NFT is that they are non-fungible. Every NFT has a digital fingerprint on it that makes it effectively unique, and it's cryptographically verifiable in a decentralized way. And what that means is that you can tell one NFT from another NFT by virtue of verifying it on a network. There's no central party in charge. So what an NFT really is, it's not just about Beeple getting 69 million bucks for a painting. It is about an entirely new technology, an entirely new category of asset where we can do incredibly interesting and different things. I think it's super fun that someone just bought an NFT with my dopey face on it for 390 bucks. But that's not really what it's about. That's a bit of sort of harmless amusement. That's not really what this revolution is about. What this revolution is about is the ability to take any asset anywhere in the world and programmatically have it be associated to value, and to do it in a way where you can generate additional units in a way that's stable, reliable, predictable, and verifiable. So what we're seeing right now with regard to the collectible edition, sort of, you could call it CryptoKitties 2.0. That's really not what NFTs are about. That's a kind of a peripheral use case. That's an edge case that people are participating in now because it's a little bit fun and it's a little bit silly. And when someone makes $69 million for a piece of art, obviously people take notice. Two things I would say about Beeple's piece. First of all, it's a really interesting piece as far as art goes. He took photographs every day for many years and he aggregated them all together on this token. So it really is an interesting piece. But the second thing I would say is in 1914, almost 107 years ago today, a French painter named Marcel Duchamp entered into a show a piece that he called Fountain. And Fountain was a urinal that he had written the word Armut on. And there's a huge controversy about it. The original was lost. A replica of it now hangs in the Tate Modern. It's a seminal piece of modern art viewed by collectors. The art market has always been bizarre, right? It's an unusual place because there are really interesting and creative things that are happening there. People are pushing boundaries. They're doing interesting things. So when you see that $69 million number for the Beeple piece, I would say take it in the broader context, not just of everything that's happened in the token market, but also everything that's happened in the art market, which is a world that, frankly, I'm not a participant in, right? I know a little bit about it, and the history is really fascinating, but that sort of tells you, listen, this is not the world of the asset world that we live in. So I would say those two things are really the key points to understanding it. We can talk a little bit more about some of the use cases for what you could do with NFTs, but basically, I would say don't look at these, the headline number on the 69 million bucks for the Beeple piece, or the, that why would anyone want to spend 390 bucks for an aggressively neutral token as the use case for what these really are. Because I concede and I agree, in fact, that it can get a little silly, number one, and number two, obviously it's incredibly hard to price these things in a way that corresponds with some identifiable use case or cash flow.
Ash, I know Max has got a lot to say, but well, one, I just want to say, Ash, when you say it's $69 million, like I automatically always think in ETH, so I always have to go back to dollars just because I'm so used to thinking in Ethereum.
Yeah, sure.
But on a serious note, I have to say to everyone who is watching on the Real Vision Daily Brief YouTube channel, please like and subscribe to us, and you can see all these episodes that come out every day. And also just go to realvision.com. If you're someone who you like financial markets, you're very interested in it, you follow the stock market, you read the Wall Street Journal, you watch financial TV, this Real Vision is the place where if you really want to learn what's really going on, you go. And I'd say like the interview that Max worked on with Mike Green and Chris Cole, like if you watch that interview, I don't know how long it is, 50 minutes, like that really will educate you more than a lifetime of CNBC. But now that I got that plug out of the way, Max, talk about respond to Ash.
But I would say, Ash, that it does matter that the perception is not on the the idea of non-fungible tokens in their like most theoretical framework, and like how once we have a full developed digital ecosystem, that's totally different. Like I'm all on board with the fact that these technologies are going to create new opportunities in the future.
Right.
In the future being key there. Like people are spending ridiculous amounts of money on the idea that they're investing in that future now, which is not potentially not the case. And look, and you can talk about the art market. I can talk about like the baseball card market. Like things get hot and they blow up, and people don't have the same. It's kind of generational. Like as people grow out of it, like it's exciting to us because we're alive in this moment in time, and it means something to us because we've seen this revolution. But the market for Howdy Doody merch is about to fall off a cliff because nobody who is alive to watch Howdy Doody is going to be alive to buy that shit. So that's what I'm saying. Like for us, it matters because we're in this moment in time and we can see it all happening. But until that, there is this thing and it exists forever in continuity. I don't really see it.
Well, let me give you my two favorite use cases. I think those are fair points. But I would say that, Max, that argument, the way you've structured it, is still talking about NFTs as though all of the use for NFTs is purely in the collectibles market, and I don't think that's the case. So one example.
No, I'm saying the perception of the public is that that's what NFTs are, and that most of the people who are espousing the virtue of NFTs are attributing it to that market, and so that makes it important to discuss in that framework.
Yeah, and I think I would agree with you that I don't see that framework as being the most compelling case. Look, if Ether is ripping right now, ETH is now, it's up about 15x on the year, trading over 2,000 right now. But that's not specifically, it's 2107 right now. I keep forgetting that we're doing this live. We can actually quote live prices. It's super fun.
Yeah, Ash, I just want to say, so the dollar right now is trading at about 1/2100th ETH. That's how I think about it.
Yes, I'm sure you do, Jack. And the market cap, by the way, is up to 242 million, so it's roughly $250 million. That's a claim on the future. That's not a claim necessarily on the digital Howdy Doody space. That is a claim on the network itself. But I'll give you a use case that I think is incredibly interesting, and it's something that Mark Cuban has talked about with regard to the Dallas Mavericks, which is the use case for NFTs and ticketing. I've talked about this before on the program, but just for people who haven't seen it. So there's that moment when you go and we would never do this, Max, I know, and I know Jack wouldn't, but if you go up to Yankee Stadium and you scalp a ticket in the parking lot of Yankee Stadium and you buy that ticket, you hand a guy you've never met before $100. He hands you this ticket and you think, oh, well, I hope this wasn't something that he printed in his basement. And there's that anxiety that you feel from the time you buy the ticket to the time you give it to the guy who's taking the ticket at the gate when you walk in, and then you breathe a sigh of relief because it was in fact genuine, hopefully.
When Yankee Stadium starts using NFTs to do their digital, but they already have digital verifiable tickets that are centralized. Like I can buy a ticket on my phone, and you could very easily create a centralized app or for scalpers. Like that's the Yankee Stadium scalper app, and they want a thriving secondary market for their tickets, and the Yankees can build their app. Like why?
Well,
why not?
Because the history of these networks is that open networks generally outperform closed networks. It's the history of TCP/IP. It's the history of the internet, and it's the history of the banking system. If you think of fixed messaging and SWIFT. Open networks tend to outperform because they're able to generate collaborators. They're generally able to create a greater degree of service through the creation of new products and services, and they're able to broadcast the economic incentive structure to any participant or member of the network. And that is the case in a nutshell for why that would be the case.
Why can't I NFT my fake ticket? That's what I'm saying. Like if the Yankees, a centralized entity, is still putting out the tickets, then there has to be some verification. Like there's still an entity which is putting out those Yankees tickets. So that's what I'm saying. Like if there's a decentralized place where people can NFT their tickets to verify them, the Yankees still have to be in on that. There is still a truth machine coming from the centralized aspect of it. So that's where I don't see the use case here.
Guys, sorry, I got to interrupt. We're getting the tap on the shoulder to end this, but we can talk a little longer. But I just want to let you guys know that we're getting the tap. But Ash, I want to ask you, like, when this NFT was sold of you, you own your own image. The image probably was taken by one of our video editors. Right. The person who made the NFT, I don't believe paid you or paid that person. I forget the person who did that, and
John
I have a lot of there we go, that person. Yeah. But Ash, the reason that they get the money is because you're okay with that. If you said, oh hey, actually, I'm my own likeness, like, is that disputed? Is that resolved over Ethereum, over the blockchain?
Yeah, look, these are all open questions, and the reason why it's just fun and silly is because it's $390 and not $390 million, which point where we would probably have lawyers involved. So it is very early. I think of these as kind of like active test cases, testing in production, alpha production, whatever you'd like to call it. But to Max's point, I think you raise some good points here. I would probably say that the asset itself is independent of the network, so you can have one authorized user who creates the NFT ticketing, and then the network is distributed. And so I'm not sure that the use case as you frame it is exactly the way it would correspond to the implementation. But look, these are real questions, and I often I think it's worth remarking that just the general trajectory that these markets are tending in is toward these decentralized and open networks. And I think that's really where the future is. And I think that's a lot of where the excitement is. And look, for me, and maybe this is a good place to wrap it up here, the point that really I think is most salient here and most compelling is that you have some of the smartest people in the world, young men, young women, who are involved in this space because they see the promise. Now, people who are outside the space, people who are skeptics about the internet, for example, and believe me, there were many of them in the late 90s. I remember people saying, I just don't have any use for this. Why do I need an internet connection? The reality is that the future is being created by the people who have the vision to figure out the ways of implementing and using the technology in a way that adds value to people's lives. And I'm quite bullish on that future. I imagine that's the direction that we're going in, and I expect to see more of it, and I expect to see more successes, along with some bubbles of silly things that don't make any sense blowing up.
I think it's a fair assessment, Ash.
So, Jack, are we wrapping here? Are we like done with the show? Are we reaching that point where we have to go?
I mean, I guess so.
I have to write some copy, and it's Friday night.
Yeah, I'm going downtown, Ash.
Nice. Yeah. So anyway, let's just come to a little bit of a framework here for talking about some of the things that we've discussed. What are your final thoughts about this, Jack? You came in here, obviously, you've been doing a lot of thought on the bond market, on what's happening with the jobs report today, and with the broader context of macro policy and U.S. markets. What are your final thoughts that you'd like to leave our audience with?
I think I would leave the audience with the thought that economic growth, the economy doing well, yes, that obviously is great for the real economy and real people, but different assets respond differently to it. Risk-off assets like bonds actually perform well when the economy is not doing so well. And when I'm talking about bonds, I'm talking about treasuries. Likewise, secular growth stocks like Facebook, Apple, or whatever, they perform decently well on a relative basis when the economy does not perform well. It's the cyclical stocks that are really dependent on the economic cycle. And because the economy is doing super well, they right now are ripping at the expense of bonds, at the expense of growth stocks. So that's something to keep in mind going forward.
Yeah, very well said. Max, final thoughts, and tell us a little bit about what you're working on today and how people can get access to it, some of the interviews that you were talking about earlier.
Well, Jack kind of covered too much. I mean, the market was closed today.
Yeah.
We have a long weekend. There's more to life than markets. So everybody should, enjoy the break when they come. Unless you're a crypto nut and you're just trading that 24-hour-a-day market, more power to you. But
in which case, we hope you come and sign up for Real Vision Crypto immediately.
Yes, exactly. But yeah, on Real Vision, all the interview that I was mentioning with Mike Green is live on Real Vision today. There's another interview with Mike Green coming out on Tuesday, which is really interesting, with Marco Papich, and they are looking at geopolitics and some trades to play some of the geopolitical tensions. That's very interesting. A lot of conversations about geopolitics don't always include the trade that goes along with it. So I was pretty excited to see that, and I'm actually not finished with it myself. And then, yeah, the Marcus Frampton interview is on Real Vision. And then, as Ash said, I mostly work on Real Vision Plus. So a lot of the live streams that we do at Real Vision are actually for our premium subscribers. And, that's a lot of fun getting to interact with our premium members, because, they've really invested in themselves. And I can tell by their questions and the type of stuff they engage with. So that's really what I like. And we're pretty fortunate to have such a great audience. So.
Very well said. Jack, Max, thanks for joining us. Have a good weekend, everyone.
Thank you.
Thank you, Ash.